This week, Chipotle Mexican Grill (CMG) stock was crushed, dropping over 20% in a single day after disappointing earnings report. Now, the stock is down almost 50% year to date and 52% from its all-time high. For a company that has consistently delivered mid-teens revenue growth and fantastic free cash flow per share growth above 20%, this massive drop simply doesn't add up. Or does it? This is exactly the kind of marketing efficiency that we look for on this channel. The kind of panic selling that creates the best investment opportunities. Chipotle stock has arguably never looked this cheap in history. But is this the perfect time to back up the truck, or is this a value trap in disguise? In this video, we are diving deep into the fundamentals. We will break down Chipotle's competitive advantage, analyze the true health of their business model. We are going to learn exactly how to value a high quality, high growth business when the market is throwing a tantrum. If you want to find undervalued stocks and understand the difference between a great business and a great investment price, make sure to hit that subscribe button right now and turn on notifications. So, what exactly is the business we are analyzing? Chipotle is the undisputed leader in the fast casual dining space, a fantastic segment of the restaurant industry. Their main competitive advantage, or their moat, is built on three pillars. First, their powerful brand and food with integrity philosophy. This isn't just marketing, it allows them to command a premium price and fosters incredible customer loyalty, especially with the key younger, health-conscious demographics. Second, their operational simplicity. The focused assembly line kitchen model is a competitive advantage that allows for faster service, higher volume, and efficient labor, leading to industry-leading restaurant margins. And who doesn't like Mexican food? Finally, their expansion strategy. The rollout of Chipotle lanes, their drive-thru lanes, is a massive growth lever, enhancing convenience and driving new unit economics that are simply unmatched by competitors. They have a huge runway for store growth, both domestically and internationally. This is a business with a proven track record of excellent management, high returns on invested capital, and a clean balance sheet with virtually no debt. In short, it is, by all measures, an incredible business, but a good business at a bad price is a bad investment. So let's look at the fundamentals and valuation. How can you spot a company with great fundamentals? Basically, you have just look at the graphs, and if they trend higher along the years, it is a pretty good company with great fundamentals. For example, revenue, net income, free cash flow going up every single year on Chipotle. In terms of margins, increasing their margins, so that's great. Earnings per share and free cash flow per share going up at a really fast pace, so that's incredible to see from a company. Returns on equity and returns on invested capital trending higher as well. It's something that we like to see as well. Shares outstanding, no, that one we like to see going down, and they have been buying back shares using their free cash flow to buy back their own shares. That's a good side, so we like to see them as well. Let's look at our money checklist. It's all check marks. Chipotle is a great company, and let's see why I love this company. It's my favorite restaurant stock, and it's one company that I have on my watch list for a long time, but just now it's starting to look at fair valuation, but we'll look into that next. They've been growing around 17% per year revenues. Market potential and growth for the next years is huge. They are expected to grow earnings per share around 9%. Their revenues, I would say that's very high quality. Look at that, growing every single year. Same store sales growing. That was the first report where their same store sales are not expected to grow due to consumer concerns, but for the history and probably in the next few years, it is very recurring consumer base. It's high quality revenues. They've been developing new products, new meals, trying to automate their lines and trying to improve their business and their margin. So I would say they're investing and trying to get better in terms of profit margin, gross margins above 40% now, which is very good for a restaurant, and profit margin, free cash flow margin around 13%, which is incredible for a restaurant. So they have the best margins in the restaurant, so it is probably the best restaurant in the world, in my opinion, and I love that as a company. They have been maintaining and growing their margins, both gross margins and profit margins and free cash flow margins, which is a good sign. They have better margins than competition. They have pricing power. Right now, that are some doubts about that. They have been increasing their prices every single year, but now they are facing difficulties with their portions, for example, high protein prices. But this is, in my opinion, temporary issues that they could be solved. But their brand, their business model is incredible, and people love Mexican food. And their prices are very competitive when you compare to other restaurant brands. They basically has no debt, I would say, because they have no long-term debt. They have capital leases obligations, but because of their franchise, they use leases. They don't have a high investment capital required for their brands, so that's a good sign. In terms of returns on equity, average 35%, right now above 40%, which is incredible. Management, even though they lost their old CEO Brian Nicol, right now they changed it. We don't see if this new CEO is good or not, but overall in history they have an history of have good management. Their moat, they have plenty of, it's a wide moat, I would say. Their brand, their efficient scale, their efficient, you can see that by their margin, their growth. Free cash flow per share growth 65% per year, which is incredible. It will be slowing down, but even though it is a great growth in the last 5, 6, 7 years, they have been returning capital. They have been doing buybacks and dividends. No, they don't pay a dividend, but they've been doing buybacks around 1 or 2%. And with this crash on the stock price, I'm expecting them to return capital to the shareholders, increasing their buybacks, for example. And with that, 84 quality score, which is one of the highest in my watch list. So love to see high quality company, but it comes with question: is it cheap? It is not cheap. It could be around fair value. We'll see in the valuation below. But for now, I will not say that's incredible cheap or value territory. Is it an incredible business? Yes. What am I missing to invest in? What is the problem of the bear case for Chipotle? Consuming slowing down. It is a sign. Consumer in America, it's not showing good signs. We are seeing consumer going down in some companies, but economy looks good. But let's see if the consumer recovers. They are not growing organically. Same store sales decreasing or around 0%. I hope they solve their problem. I think their problems are easily solved. They have to gain their clients' trust again, but it is an incredible business model with plenty of tangible addressable market, can grow international as well. So I see plenty of growth ahead for Chipotle. So for 3 sources of returns, yes, revenues and earnings growth. Yes, definitely they will continue to grow their revenues and earnings. PE expansion, yes, right now 25 forward PE. I would say they deserve a 30. Historical mean in the last 5-10 years is 35. Growing around 10% with this quality, they deserve 30 PE at least. It's not cheap in terms of PE ratio, but you could see some expansion in the future if they resume growth again. Buybacks and dividend, yes, they are doing buybacks. But is this a great company? Yes, but is it at a fair value, cheap, undervalued, or is it overvalued? I'll do my discounted cash flow analysis. US company, so it is a very safe, I would say, to their quality. and due to their steady growth. So I would say even though it's a consumer, it's depending on US consumer mostly. It will be a safe company, but if you want to use a higher discount rate to have a higher margin of offset, it's okay for me. For my best case, it will be 10% for this company. So free cash flow margins. Last year they have free cash flow margins of 13.4, so I'll be conservative around 13%. I think they can have higher margin, but they could see problems, and 12-11% margin, it's not something off the table, but I will, for my best case, I will assume 13%. Growth rate around 9%, that is what analysts are expecting, and I do really believe that with new stores opening every month, every week, I think they can have a 9% growth for the next 5 years. PE, I think they deserve 22 PE, around 20 PE. They deserve a premium. It's one of the best companies out there, and yes, it might. If you assume 20, 18, 17, I will not criticize you. It will depend. Since I really like this business model, and I really believe into Chipotle's future, I will assume higher premium. But if you want to be more conservative, it's up to you. So with these assumptions, I came with an intrinsic value for Chipotle around 28.7, around 29. Right now the stock is down up to 31.5. So it's getting close. I would say fair value would be between 28 to 31, $32 per share. So right now it's getting around fair value. So for me, it will be the best time to start a position in this company. I didn't see this opportunity, or at least Chipotle didn't get my interest, because it always looked so overvalued. Right now I'm starting to look into it, and right now it's getting close to a fair value, so it might be a really great opportunity. I hope it goes down to 28, 26, around the 20s, so it will be a massive opportunity if that happens. And if that happens, I will be buying a lot, so because I really like this company, Chipotle, and it's one of the best companies out there in my opinion. So, after tearing apart the latest earnings report, analyzing the consumer health concerns, and looking at the growth runaway, here is my final takeaway. Chipotle is, without a question, an incredible, high-quality business with a durable competitive moat and world-class fundamentals. The recent stock crash, driven by near-term macroeconomic fears, has temporarily given us a fair valuation. The consumer weakness is real, but appears temporary and is already priced in. This is exactly the moment when patience and focus on long-term value can pay off. For long-term growth investors, the risk-reward profile here looks positive. We have a shot at buying an exceptional company at what could be the cheapest price in a decade. But what do you think? Is CMG a bargain, or is the consumer issue a deeper problem? Let me know your thoughts on Chipotle stocks on the comments below. And if this analysis helped you, please hit the like button and subscribe to the channel. See you in the next video. This video is for informational purpose only and should not be considered financial advice. Always conduct your own research and consult with a qualified financial advice before making any investment decision.